Good afternoon, good evening, all of you. Welcome to the second in the winter 2022 Equity Research Step Up Seminar Series, sponsored by the Center for Financial Markets and Policy, the Georgetown University Alumni Association, the Georgetown University Investment Office, and the MSB Pillars Initiative. For those of you who don't know me, my name is Lee Pinkowitz. In addition to being a finance faculty member, I am the Associate Director for Student Engagement at the Center for Financial Markets and Policy. The winter series through February is all going to be virtual, but we are incredibly pleased to have an incredible set of speakers here. And I'm going to turn it over to a man who with me is really done almost all the work. Tom's probably done all the work on this to introduce our speaker tonight. Tom, on you.
It's my great pleasure to introduce Tim Nollen to all of you. I think you should take note because Tim, to me, is a shining example of someone who has a career success story, and he's done it through Georgetown. Tim is the son of the person that was my mentor, Professor Nollen at Georgetown, and he got both his undergraduate and graduate degrees from Georgetown. When I was helping to run research at Bear Stearns, I hired him to come to Bear Stearns, introduced him to Alexia Quadrani, who spoke last night, and she added him to her team as her junior. Like we spoke about last night, this is an apprenticeship type of business. Tim learned his way through research, and then he struck out on his own to become a very prominent and successful media analyst. Tim is somebody who gives back to the university. He just, I think, a Georgetown either MBA or undergraduate just left his team. He's hired from Georgetown, and he has been kind enough to give us 2 sessions in terms of speaking to you. And whereas Alexia gave you a blueprint of how an equity research analyst works, Tim is going to go deeply into the nuts and bolts. And I think both of the clubs really need to pay attention to these sessions. With that, Tim Nollen.
Great, thanks a lot, Tom, for the intro. I'm going to add one more little wrinkle to the story here, which is I've actually known Tom since I was, not kidding, about 5 or 6 years old. Tom became a family friend as he was a student at Georgetown in the 70s, studying and working with my dad, who was a professor there, who just retired from Georgetown. Almost retired. He still does a couple things, I think, around campus, doesn't he? Can't quite get him out of the building. But he was there for 46 years as a full-time faculty member. So I am blue-blooded Georgetown through and through. I am burning up with the way the basketball team is doing this year. I watch almost every single game. I got my undergrad from Georgetown. I went back and got my MBA from Georgetown a few years later after I had traveled around the world and had lots of fun. I did pay for the MBA, by the way, and I am very pleased to be involved with the community here. There's also another person involved in the story with me getting my career off the ground, and that was before Alexia. I actually worked with not one, but 2 other Georgetown alum at Bear Stearns. I'll spare the details of that, but there's literally, 5 people just, in the picture right here that are all Georgetown graduates. So it is a very big, very rich community of people that want to help you out. So please do take advantage of the potential to develop networks there. I've saved a few comments for that I'll probably get to at the end of the next session next week. I had a few more words I wanted to go through on that. So basically, yeah, so as Tom said, so I've been a sell-side equity research analyst now for just about 21 years. I interned at Bear Stearns while I was doing my MBA at Georgetown, finished that in 2001, and then went back with a full-time offer to Bear Stearns. Bear Stearns, if anybody of you know the history there, basically collapsed into JP Morgan in 2008. I went to work for JP Morgan, at which point I was in London, did that for a year. And then in 2009, perfectly timed at the bottom of the market, I jumped from JP Morgan to Macquarie. Macquarie is an Australian investment bank. We are one of the biggest banks in Australia. And in terms of our equities brokerage presence, we are one of the biggest top tier firms in Asia Pacific. We are much more focused in the US, whereas if you listen to Alexia's presentation last night, she is, she is the top of the heap at one of the top banks, of course, in the US. Macquarie is much more focused on two main sectors, consumer and TMT, tech, media, telecom, in the US. My coverage is what I call media tech, actually. I don't call it media so much anymore because so much of what I have worked on over the years has seen traditional media migrate to more data-driven and more technology-driven functions. And in addition, I've picked up coverage of a lot of stocks over the last few years that are really, companies that only came into existence over the last 10 years or so. And so they really are, data-driven, technology software companies that happen to operate in the field of media and advertising in general. So I'll get into some of that. If you listen to the presentation from Alexia last night, you think this is just kind of an overload of media and technology stuff, and that is partly just by design because I did work with Alexia for a few years, and I've gone off and done my own stuff there. So anyway, it should be interesting and topical. At least you guys know who Disney is, and you probably play video games and all that sort of stuff. So hopefully that's of some relevance. The format I think I'm going to go through tonight is I've got some slides here. I've got basically enough slides for 2 or 3 sessions. I'm aiming to get through, roughly half of this or so today. And here's the outline. So what I thought I'd talk about today is talk about what equity research analysts do. You got some of this from Alexia last night, so I'll go over that pretty quickly. The difference between the sell side and the buy side and what we do. I want to talk about how to analyze a stock, basically knowing the industry, both cyclical and structural factors. I want to talk about the qualitative assessment of how to understand what makes a good company, what makes a good stock, and then the quantitative assessment, basically what the earnings forecasts, how to do earnings forecasts, how to understand balance sheet and cash flows. If we get through all that today, we're doing great. And then next week we can talk about valuation and presentation skills. And I'm going to say right up front here, do not underestimate the importance of writing. I know Alexia said something to the effect yesterday that you'll go to Georgetown, you're probably good writers. I certainly hope that's true. If I can just be so blunt, most people are not good writers, okay? And I really struggle with people that do not write well. It's an underappreciated skill. It is extremely important in this job, which is, in my opinion, based on the written product first and foremost, and everything else follows off of that. Okay, so that's that. So let me jump into it. What does an equity research analyst do? You got some of this from Alexia last night. Let me just fill in a couple of what might be some gaps. We are divisions within the banks, in some ways sitting alongside investment banking, but we're very much separate from investment banking. The sell side basically brokes stock ideas to the buy side in exchange for trading commissions or research fees. Research also does support the investment banking divisions, for example, in working with IPO processes or helping vet companies for M&A or for debt raising or whatever else the firm might be doing. Sales, trading, and research divisions are very separate from investment banking. Alexia talked last night about the wall, the Chinese wall between research and banking. It is very high. It is very important. But we do work both with the institutional investor side and with the bankers internally. Just listed a few names. I think you had JP Morgan last night. I'm with Macquarie. You're going to have someone from UBS, I believe. Is that right, Tom? That's going to come on in a couple of weeks' time. And then you also have independent research firms. A guy named Ed Wolf, another Bear Stearns guy. I don't think he's going to be part of this series. We might be able to get him on later. But he's a Georgetown grad. He has his own research firm, now Wolf Research. Let me just make sure I'm going through the points I want to make. Okay, so so that's the sell side. Who is the buy side? Who are we broking our research to? I think of it in terms of four main buckets. You've got mutual funds. I believe we're going to have a speaker in this program from Neuberger Berman. It's one of my larger clients. Fidelity, BlackRock, and many others. Hedge funds that you read about a lot, Citadel, Millennium, et cetera. Pension funds, a very important client of ours. One that I've thrown on here, Macquarie being Australian, and strong in Asia Pac. We do a lot of work with Employees Provident, which is the Malaysian or some kind of Malaysian pension fund associated with the government, very, very large. And then there are sovereign wealth funds. Look at Norges, for example. They manage all the oil money out of Norway. We work with GIC Singapore, Norges, and others. So basically, Alexia talked about these other points here, I think, so I'll skip through the rest. Just to the last bullet, though, I think it's a very important point here that there are different styles and mandates within the buy side. And that means you're going to talk with different investors depending on the type of portfolio and focus they work on. You might talk with someone that works on a growth team, so covers growth stocks, which these days means a lot of tech stocks, or someone who works with a value focus. Value is very much the flavor of the day right now. It has not been for most of the last 10 years, but oversold stocks, companies going through transitions, therefore usually trading at low multiples. You can talk with value investors on the buy side. I cover TMT on the sell side. My coverage happens to be quite broad, actually. I cover advertising, traditional media, networks. I'm going to get to that in a second. The buy side client base is much broader even than that. I might talk to someone that covers video games, where I don't cover all of them. They cover the whole range of consumer or TMT. My coverage is more targeted. Get to the next slide. So what I do basically is, as I said, I cover traditional media, which has migrated rapidly to more digital things over the last many number of years. Just look at Disney, for example, launching the Disney Plus service, Discovery launching Discovery Plus. And then, a lot of new services have emerged, streaming services. I cover Netflix, Roku, and Spotify. Then on the traditional side, you've got, a lot of changes in the industry, like WPP, a major ad holding company, or Omnicom, is actually funneling a lot of its ad buying through the Trade Desk, which is a company that came into being about 12 years ago. Its market cap is now greater than the total of all the traditional ad holding companies combined. And what it does is targeted, automated ad buying on behalf of the agencies. And then new companies have emerged. I'm going to mention Unity in a little bit. Unity Software is a gaming platform, and they also have a big ad tech business. They place ads for games within mobile games. Any questions so far? Or I'm going to jump on into how to look at a company and an industry. Any questions so far?
I'm monitoring the chat. We don't. It's so far just me chatting at the moment, Tim. But I'll chime in. I'll break in. And for the students out there, feel free to take this opportunity to have this conversation as we've done before. Go ahead, Tim.
Okay, let me talk here about kind of the starting point for understanding how a stock might trade. You have to understand the industry backdrop. What you have here on the screen is, on the right-hand side, a clip from a note that we did, in December, kind of a year ahead, themes, for 2022 for traditional media. I'm just talking traditional media now, ad agencies and TV network groups. Advertising is one of the drivers, of course, of this whole sector. It's a very macro-sensitive industry, very closely tied to the macro economy, which means GDP growth, unemployment, consumer confidence, purchasing managers index, interest rates. All of these are very important factors in understanding, what drives advertising spending, and then of course it's the ad spending that drives the revenues of these companies in different ways. And so you can just see on the right hand side here, I've just referenced some of these issues. into 22 things like supply chain causing inflation, which is therefore prompting the Fed to raise interest rates. These are the kinds of things that we think about on a certain level. And then you have to understand, how these matter for how the stocks trade overall. We've done some work many times over the years looking at how media stocks tend to trade in certain points in the market cycle. So I know this is a little bit small. I hope you can see it. If you look at the chart on the upper right-hand corner, what we're showing here is Omnicom stock, which is one of the big ad holding companies. We were curious, how does it trade when the Fed is raising interest rates during interest rate cycles? Because we're now going to be entering one very soon. If you go back to the last two recessions, so the gray bars, sorry, not the last two recessions, the last two Fed interest rate raising cycles. That's this bar here from 2004 to 2006, and this bar here from 15 to 16 or 17. The orange line here is Omnicom stock indexed, and the blue line is the S&P 500. And what I wanted to see was, how does Omnicom trade compared to the S&P 500 index? It's not a huge difference, but if you look at this low point here going into the rate raising cycle, it kind of outperforms the S&P 500 index between here and here, if you can see that. Whoops, I didn't do that in a second. In 2015-16, it was more pronounced. You're starting from a more similar basis here. It's outperforming the S&P in the early stages of the rate rise cycle. Okay, that's just one factor to bear in mind as to how the stock might trade. So we made the call in our year ahead preview note that Omnicom was already maybe a month or two into this outperformance phase, which it has done, in fact, continues to do versus the index. That is because, as I referenced before, it is a value stock. It is a company going through transition. It's relatively cheap. And that's why at this phase in the market, it has been outperforming. If you look at the bottom chart here, this is showing on a much more condensed basis. The top chart is over 20 years. The bottom chart is just over 2 months. The orange line indexed to 100 is Omnicom stock. The light blue line is the S&P 500, so you see slight outperformance there. But interestingly, looking at a couple other stocks that I follow, Viacom CBS, the media network group, that's basically underperformed. And the Trade Desk, which I referenced earlier, which is really a software company, really an ad tech software business that works on behalf of agencies, it has also underperformed both Omnicom and the market. So I get questions from clients saying, oh, why is the Trade Desk down so much? Well, it's down because all growth stocks, all tech stocks basically have been down in the last couple of months. So just understanding the principle behind how that works, I think gives you the frame of reference there. And so I got a question from someone today again, why is Trade Desk down? I said, actually, it's not even down that much compared with some other stocks that I follow and some other technology names that are out there, software names that are out there.
So Tim, there's a great question from Nick in the chat that I want to combine with something that I was going to ask, which is how much do you have to be a macro forecaster, right? If you're talking about raising rates, right? If you're talking about, well, I know this industry, I know this stock, but you're not necessarily a macroeconomist. Are you working with people inside Macquarie? What about people who are independent researchers? And then let me just throw in Nick's question, because it's a fantastic one and certainly something that academics always study. How do you know that the past history of how a stock performed when the rates rose will be replicated, right? As you know, virtually every disclaimer you're going to have on anything you write is that past performance is not indicative of future results, except you're now showing them past performance. Feel free to take those in either order. Thank you, Nick, by the way.
Totally good point. So I've got a few slides down talking about resources that we use. One of them certainly is internal teams. Macquarie has a chief global economist. We have regional economists. So I read our global economists. I read our U.S. economists. We have an equity market strategist who talks about this kind of thing, when to buy value stocks, when to buy growth stocks, et cetera. We have a currencies analyst. We have all kinds of commodities analysts. That doesn't affect media so much, but it does affect lots of other sectors. So we use all of those resources. No, I do not try to be a macroeconomist. I do not predict when the Fed is going to raise rates. That I completely leave that to reading the Financial Times or paying attention to what Macquarie economists are saying. I'm sure Alexia does the same thing. JP Morgan has their teams of people who do all that. So that is definitely that. In terms of, yes, the past does not necessarily predict the future. Absolutely true. And actually, to demonstrate that point very clearly, if we go back to the chart here, you can see where I've got the cursor moving, I guess, right, where the arrows are. Yep. Okay. So the point I was making was Omnicom outperformed the S&P in the early stages of a rate rising cycle. Okay. Look, however, after that, from then on, if you pick this spot here to this spot here, it's pretty much just bang in line, not outperforming, not underperforming. Look what happened in 2016-17 though. From here, I keep doing that. From here to here, that's pretty severe underperformance versus the S&P going up whatever percent it went. Right? You've got Omnicom going one way down, you got the S&P going one way up. That is because structural factors came in at that time. And I'm going to get to that in the next section of the presentation here. Structural factors are things like, in this case, technology basically has changed media dramatically in the last, well, over the last 10 years, but really especially in the last 5 years or so. And so the stocks started to reflect that kind of in this phase here. So I'll get to more things, but it's exactly the right question to ask. This is one factor to bear in mind. Definitely, the past does not always predict the future.
And Tim, I'm sure you may get to this, but just to kind of keep Nick's question at the top of mind for everybody, as you go through this, it's not just rates, right? But you know, an analyst needs to understand where a firm has come from, but how do you start to distinguish basically just explaining what a firm has done from analyzing what you believe it will do? I'll let that hang for if you want to pepper it through as you go through.
Not to sound trite about it, but that's basically why I have a job, is I'm supposed to figure that sort of stuff out. And by the way, Alexi said this last night as well. You know, I might be wrong. I've certainly made some wrong calls. But if you say things that are intellectually sound, that maintain some integrity of your point of view, that, for example, follow on an argument that you've made over a course of time, or that respond to changing news, investors, you know, will respect that. And even if I get the stock call wrong, as long as I'm saying something that makes sense to them, that is information they can use and generates a conversation and an idea, then my role is served. So, you know, look, there are analysts who like to be the axe on the stock. They're the best stock picker. That's their thing. My thing is not quite that. I don't try to be the stock picker. That's not my MO. The way I operate is I want to be someone who is thoughtful, that can think through lots of different issues, lots of different factors, and therefore be point of contact for people that want to bounce ideas off of. Sometimes my best communications with investors are people that violently disagree with my point of view, and we'll have a very vigorous argument back and forth. And usually we'll step back in the end and say, okay, I respect your point of view. I disagree, but I get what you're saying. So that's part of the job.
But Tim, your point of this is that you do some top-down analysis before you dig into what your next section is, right?
Oh yeah, I'm going to get into that. I'm going to get yeah. This is kind of the 30,000 foot level, kind of where to start in some of the factors that matter. Well, here's the structural bit right here. Okay. I referenced with regards to Omnicom how the industry started to change, technology started to become much more important, and the ad holding companies, you know, started to fall behind in kind of 16, 17 period. Here's another way to look at it, probably a bit more immediate, and I think you all probably have personal experience of this. All of the TV network groups now have their own direct-to-consumer streaming services. Okay, Netflix came to market and started this whole streaming phenomenon. It didn't really, it took until 2019, believe it or not, for Disney to finally come out with its own direct-to-consumer streaming services, i.e. not going through the cable TV operators, where everyone pays for the full bundle of cable services, but direct to consumer. You don't need cable, you just need a broadband connection. You subscribe to Disney Plus. I know you all know that. So this has been a major structural change in the industry. And so if you look at, and the reason for that, by the way, is the traditional media TV network business model has always been the networks, Disney, ESPN, MTV, Nickelodeon, Discovery, etc. They would always sell their network packages in a bundle to a cable distributor like Comcast or like Verizon Fios. And it was a virtuous circle as long as penetration rates in households was going up and as long as they were raising prices. So they had everything going in their favor from the 1970s until around 2014 or so. I'll show that in the next slide. Then things started to change. Netflix started to really interfere with the pay TV universe, and investor enthusiasm for the stocks started to fall. And you can see that very clearly here. So the black line going across is the 10-year average. I believe it's EBITDA multiple for the media network groups. The red line is the 5-year average, and the green line is the 2-year average. So you can see the average just keeps going down the more recent the time period. And if you look at each of the stocks, they've all basically gone straight down. It's most visible of AMC Networks here, pretty much going down in a straight line for the last 10 years. So that is the EV to EBITDA multiple for these stocks, with fluctuations, of course. Some good news comes out, then followed by some bad news. But the general trend has been down because the sentiment amongst investors has been negative on the traditional media networks. Okay, I think that's the point of it. You can see more clearly, very, very clearly what I'm saying now. And even this chart here on the right is out of date now. This was from 2020 in a report that we did. It's eMarketer, which is one of the third-party resources that we use. Gave this forecast. It's very self-explanatory. Pay TV households peaked at about 100 million in the US. It's now down. This is looking like 80 million, so it's more like 75 million now. This orange line has turned more sharply down. Non-pay TV households and cord cutter households, people that used to have pay TV but have now dropped, cut the cord in favor of Netflix or whatever, has clearly gone up. I believe these two lines have actually now crossed. Here we are in 21. The orange and the blue lines, I think, have actually now crossed. So COVID, of course, accelerated a lot of those trends starting a couple of years ago. But that very clearly shows what the what that structural factor is. So this on the left is a bit from a report that we did on connected TV, Roku and other, Samsung smart TVs, and the market that they are creating for streaming content. And so this, I think, shows that quite clearly. So last bit on understanding the industry, just through a couple of front page notes that we've done. On the left is something, Alexia spoke yesterday about, the types of research that she puts out. I would just add maybe one more kind of type of research that we produce, which is a chunky thematic report. She talked about primers. I personally don't really do primers, but I do thematic reports. So this one on the left is a report we did on e-commerce marketing from middle of last year. You can see about 45 pages. The one on the right is just from last month, Unity software, game engine software with an ad tech business attached to it. We did a stock specific, looks like a 17-page report talking about Unity, talking about a theme with this particular stock. And so both of these, I put these up here as examples of, kind of industry reports. You have to, dig deep into what's going on in the whole industry to understand the background. Now, the sources. So this is this from a prior question. It's a very important point. I reference, the first bullet here, the internal sources that we use. We do certainly read general press, the Wall Street Journal, the Financial Times, the Economist, etc. By the way, and I'm going to say this again when we get to the writing bit, read the Financial Times and read the Economist, please. They are so well written, and try to understand the way they are writing their articles and try to emulate that in your own writing style. Both of those publications, I think, have a great way of appealing to both the expert and the novice who is interested in the topic. In my sector, we have industry-specific press. We subscribe to Adweek and Digiday, and we have resources from eMarketer and IDC and other sources. And I'm reading these things all the time. I mean, I probably spend an hour a day reading all of these things, if not more. And then discussions with companies by investor relations, and obviously from contacts that you develop over the years, the conferences. You follow the industry for a long time, you get to know people. You make a Georgetown connections. I have done this talk with Georgetown alum that are working at various companies and industries that matter to you. All right. Qualitative assessment now. This is an important point to remember. You can like a company, but not a stock, and vice versa. I'm going to show you some examples. So what makes a good or a bad company? The strategic vision of the company, whether the company has technology leadership or not, whether they're investing for long-term growth, what is their differentiation, what is their moat? I'll give you an example of differentiation and moat, for example. The Trade Desk, which I've referenced before, is a company which simply, I would say, was the best at building the market for automated ad buying. Without getting into the details, if you kind of know how a stock is generally traded these days, you don't pick up the phone and call your broker and say, buy me 1,000 shares of Disney. You enter the order electronically, it all gets processed like that. Advertising media buying is largely done the same way now, with digital media, with search, with connected TV buying. And the Trade Desk has essentially created its position as by far the biggest and highest quality independent ad buying platform. It positions itself as the anti-Google, right? Google is a walled garden. You want to buy ads on YouTube, you have to use Google's technology. You want to buy anything else, you can use Google's technology, but if you use the Trade Desk, you're guaranteed independence. Okay, so that's the differentiation, the moat that the Trade Desk has created for itself, is that scale and that quality and that anti-Google stance. Other factors there: quality of management, ability to manage risk, and so on. What makes a good or bad stock as opposed to a good or bad company can depend on a lot of things. I mentioned a few slides ago talking about just the phase in the market. You know, rates are rising. You know, you might want to be buying, you know, GDP, you know, advertising sensitive names because a little bit of inflation is good for advertising spending. Or value stocks, you know, come out of the recession and they rise, you know, versus the market at certain phases. So that's one, you know, most obvious extreme case of this would be in a recession, you probably want to be buying healthcare stocks, and coming out of a recession, you want to be buying these big cyclical, you know, for example, ad-driven stocks, because they'll probably have the best outperformance. But a few other factors can matter here. So on the chart here showing Charter Communications, cable company, very interesting how the stock has performed over the last 5 years. 2017 to 2019, you can see the stock was, call it flat versus the market. Market was more or less up. Charter was basically up and down, kind of overall flat. Then starting in 2019, Charter just took off. Here's the S&P 500, obviously great, you know, performance in general, but Charter has outperformed that. Forget this up here, that's something else. But from the bottom, from early 19 through, you know, mid 21 or so, Charter outperformed. The simple reason is, during this period, Charter was investing very heavily in DOCSIS technology. During this period, its heavy CapEx investment phase was behind it, and so the stock just simply went on a run because the earnings and the free cash flows were improving. That's one thing that can affect, you know, your understanding of a stock. Another one might be, back to the Trade Desk example, simply headline risk. So Apple came out with this this change in its methodology about a year ago, where they were going to restrict access to the identifier for advertisers, the IDFA. And they actually launched this in April of 2021. When that happened, there's this bout of fear that the Trade Desk was going to be badly affected by this change, and it wouldn't be able to buy ads on Apple devices, and it would lose the access to the data that it needs to buy those ads. And so the stock basically crashed for about a month in there. Then it went along and it did its thing. And then about a month later, we had news that Google was going to delay the impact of its third-party cookie deprecation. This is a similar topic regarding data privacy. Google controlling a lot of the reins in terms of access to data via the Chrome browser. Google had said earlier that they were going to change their whole way of making access to the third-party cookie They then came out in June and said, hands off, we're going to delay this for a couple of years. And boom, trade desk stock just shot straight back up again. In my opinion, neither of these events actually will affect the trade desk revenue and earnings. But in investors' minds, they make a they are a big deal, and they can make a big difference. So that's just to show how stocks can be affected by that.
Tim, a couple things here. One, so James has a really good question about, aside from the Fed actions, are there any other economic events that you kind of follow on your calendar, whether it's jobs or consumer sentiment? But I broaden that out a little bit too, which is, are there particular events that, as an analyst in a particular industry, you are following? So for instance, in a media, would you be looking at sort of sweeps weeks or things like that? So are there particular events that you're following other than the Fed, both macro and perhaps industry specific?
Yeah. Okay. So yes, good question with two parts, I guess. So macro wise, there's no particular one thing. I mean, a lot of these things factor in. So I don't necessarily follow unemployment rates, but inflation does matter for various things. But it's really just GDP growth, I think, in general, and just the Fed raising rates is kind of topic du jour right now. So that's why we'll focus on that. But a broad range of economic things. Industry specific maybe is more relevant, actually. I do a weekly piece where we track things like TV ratings, which matter a lot less than they used to. Things like box office performance. I cover Disney, and I cover, Comcast, which owns Universal, Viacom, which owns Paramount. If a big movie comes out and does well at the box office, that actually can affect sentiment on the stock. We do something similar for video games. Even things like tracking Twitch viewership of certain games. So those sort of industry specific, third-party resources, yes, we definitely pay attention to. Yeah. I think it's the last point on qualitative before I get to quantitative. So what makes a good or bad stock? Continuing this line of thought, I'm not a technical analyst. I go out to the trade desk and ask not the company, the trade desk, our trading floor, and ask my traders, can you give me a sense on, if this stock is, I can look on the Bloomberg chart and see if the stock is moving above or below a 50-day or 200-day moving average, for example. But I'll go out and talk with our traders and say, what is the market sentiment on this right now? Typically the thought being if a stock trades, if a stock hits its, let's say, 200-day moving average, either it typically bounces back up from that, and that can be a positive signal, or if for whatever reason it drops down below that, it may stay down below that for a good long time. So that's kind of one thing that we pay attention to. Valuation alone can be a reason to like a stock or not. I'm going to show you a very extreme example right here, which is Discovery stock last year. I think the subject of these meme stocks came up last night with AMC. Discovery this is around the same time. It was not really a meme stock so much, but what was going on was there was a hedge fund that ran into a lot of trouble, and it had a lot of short positions heavily on Discovery and Viacom CBS. And I don't know if it was a combination of the meme stock phenomenon and the fact that this hedge fund had to get rid of a whole lot of these short positions, basically buy a whole bunch of stock to make itself whole. Discovery shares literally tripled in the course of 3 months. And there's absolutely no fundamental reason why that should happen. This is a TV network group trying to transition to the streaming era. Why in the world should the stock triple in 3 months' time? So in one of the rare moments that I did make a spot on stock call, I downgraded Discovery from buy to, I forget if it was neutral or sell. I mean, literally right here. And I'm only saying this because it rarely happens that you're that good. But I downgraded it from here, and it almost instantly fell off all the way back down to where it was, and it finished up the year below where it started. I didn't hate Discovery. I kind of liked Discovery, actually. I kind of liked the transformation it was going through. But purely on the basis of valuation, look at some of these multiples here. Was trading at 14 times versus its historical average at 8. right? Viacom is trading at 17 times versus like double its normal multiple for no good fundamental reason. So off we went. I guess we went from neutral to underperformed. So downgraded it purely on the basis of valuation. That didn't make the IRs too happy with the companies. There's another conversation on how to handle that. But they at least understood the fact that there's something a little artificial in their stock performance. Below the line factors can matter as well. I didn't put any examples here, but let me tell you about Fox, for example, Fox Corporation. They sold a majority of their business to Disney in 2019, I think it was. Part of that transaction involved the creation of a major tax shield. So if you look at Fox valuation, it's typically priced above most of its peers, which on a standalone basis doesn't seem to make sense unless you understand that it has a multi-year tax shield built in, meaning it's going to have a lot of tax savings that it was able to generate through this Disney transaction. And then one more example here, going back to my days in London, Informa is a professional publishing business. They publish legal journals and databases and things for different industries. They were arguably over-levered in 2019, they had too much debt. And then the financial crisis came about, and you can see the stock here basically went, fell, 75%, I guess it is, in the space of 6 months or whatever that is. This was, of course, financial market crisis. They were over-levered, so huge fears about what was going to happen. Then, the market kind of turned around starting in the spring of 2009, and the sentiment changed. As it turned out, by the way, Informa did a capital raise to help ease its debt balance, debt ratios. As it turned out, when they reported earnings, they would have made it and met their debt covenants by just an absolute tiny fraction of a hair. But since they did a rights issue, reorganized their finances, and then the market sentiment started to change in 2009, look how the stock just took off from there. And this really wasn't even about revenue or earnings. It wasn't even really about cash flow. It was about perception of this company's balance sheet. Over-levered, and then all of a sudden, leverage was good again. Any questions on that before we move on to the next bit?
Tim, I'm sorry, I'm trying to define terms in the chat for those people who didn't sort of have them. But what I do want, for students who want to go into this, right? We think of it as finance, but you're starting to talk about, like below the line tax situations, hidden assets. You're talking about multiples of earnings. How important is understanding accounting, right? Admittedly, I'm a finance person, but if you're a fundamental analyst, right? If you're doing this with fundamentals, how important is accounting?
Very. You have to understand how P&Ls, balance sheets, and cash flows work. I'm going to get into that in the next section, actually. You don't have to be an auditor. You don't have to be the one that is, trying to do the ledgers, but you absolutely have to understand all the basics of accounting. I remember now, I was a philosophy undergraduate. I went and got an MBA as a career move for me. I did not have that. I really struggled in my accounting classes in my first year of MBA. When I started, Tom, you might remember this, when I started my first year at Bear Stearns, I was struggling there too. And because I didn't have that background that hopefully most of you, certainly at undergraduate level, if you're finance, accounting, whatever majors, you will be taking these classes now, which is great. I didn't do that. I remember after I got my serious licensing exams out of the way, I spent most weekends, my first year on the job, going back and reading my accounting textbook cover to cover, reviewing what I had done in school, but kind of it was so abstract at the time, and now I'm in the real world, and so what does this actually mean? So I went back and I would read like a chapter every weekend of my accounting textbook. Felt foolish doing it, but I came out of that, I think, a lot stronger because of it. So accounting absolutely matters. Finance, I mean, it's a lot of ways the same thing. Finance kind of rides off the accounting. So it is all very important. And believe me, I've cycled through a number of junior analysts over the years, and there are three factors I look for when I'm hiring somebody. It's accounting, financial knowledge. It is writing ability, which I'm going to get to later, and it is industry knowledge. The ideal candidate for me has all three of those things in equal measure. And if you've got a CPA, you can probably handle all this stuff just fine, or a CFA, maybe even better. But if you can't write, you can't really work for me. And the other way around, you know, if you're a philosophy undergrad and haven't done the accounting classes, you know, you're not going to be able to handle the financial models. So it's all very important.
Thanks, Tim. By the way, for the undergrads on the call, you know, I know you take 101 and 102, and for somebody who's like, oh, thank God those are done. You might want to start looking at like financial statement analysis, and certainly for the well, MBAs, you guys take accounting when you first come in, and it's a shock and awe type thing. So you know, in the electives, you have try and take a look at that. MIM, MSF, same thing as well. But so thanks for that, Tim.
Yeah, and actually that actually brings up a point I wanted to make as well, which is why are we doing this whole kind of what do you call this step up program? Is that the term for it?
The seminar series, yeah.
So the seminar series. It's because you get a great education at Georgetown. You learn all of this stuff by the books. It's all great. You have to learn all that stuff. But when you actually enter the working world, you can't just sort of remember all those theories that you learn. You have to apply them. And it is quite a bit more difficult to actually do it than to study it in a book. And you need that stuff. You absolutely need that stuff. But the real world somehow is a lot harder. And what we're trying to do here is give you at least an insight, or at least a kind of a view into, you know, how the world actually works on Wall Street and how you can apply the stuff you're learning an undergraduate or MBA program to what you can be doing here. All right, last bit I wanted to get to today, and hopefully we'll get through the whole thing, but if not, we'll just pick it up next week, is actually what we're talking about is more about the accounting and the financial skills and abilities that we apply. So, you know, Alexi talked last night about building models. Okay, I don't usually need an associate to build a model for me unless it is, you know, a new coverage. So we're working on a company that we're hoping to take public shortly. We've been working literally for the last week on building the financial model for that. Otherwise, it's basically company reports earnings. You fill in the numbers in terms of what they've just reported, and then you have to understand how to forecast earnings. So I'll just show you some examples here. This is I think this is back to Omnicom, actually. One way to do it would be to look at the geographic exposure that they have in terms of revenues, forecast the organic growth, call it same-store sales growth, or, you know, the like-for-like growth of the company. Layer in any acquisitions or divestitures that they might do. Omnicom, for example, was divesting companies in the past year. So they had negative acquisition growth. And then currency, foreign exchange rates, all rolls up into a total revenue figure. And that's your quarterly and your annual revenues for Omnicom. These are I believe, our existing actual forecasts for Omnicom here. Omnicom's going to report next week. It can get much more complicated than that. Here's our forecast model for Disney. On the left side here, I don't even bother to make it bigger for you because I'm going to blow out this part here in a minute. This is all of Disney's revenue lines, right? Think about Disney. They have TV networks. They have their direct-to-consumer streaming services, which is this. They have the parks. They have their consumer merchandise. All of that is down here. All of these are our forecast for Disney revenues down here. What I've highlighted here and then blown up here is our forecast for Disney's streaming services. It's newer businesses. So Disney owns Disney Plus, ESPN Plus, and Hulu. The way we forecast Disney Plus, ESPN Plus, and Hulu revenues is we look at their subscriber numbers. We try to forecast subscriber growth. We apply an ARPU, or an average revenue per user, to that, and we get to a revenue forecast. We go for Disney Plus, for ESPN Plus, and for the various flavors of Hulu. All of these then go into the direct-to-consumer line up here and is included in the total Disney revenue growth numbers here. You don't need any more detail than that. My point is just that if this is a relatively simple revenue model for Omnicom, this is a much more complicated revenue model for Disney.
Tim, can you talk a little bit about what ARPU, well, it's average revenue per user, but sort of what it means. And when you start to think about as an analyst, right, in the valuation course, we talk about value drivers, right? ARPU obviously is a value driver in that industry. How important is it, or how different are the metrics across different industries? Just so people who haven't seen this have an idea what ARPU is and what it is you're kind of, how you're building this up.
Yes, definitely. I'm going to get to valuation discussion later.
Okay.
Because things like, people not so much anymore, but some analyst investors were ascribing value to Netflix, for example, based on subscriber numbers. To answer the ARPU question, it's average revenue per user. So for example, here's a good way to think about it. If you're looking at Disney Plus, okay, we have Disney Plus subscriber numbers going up, okay, 118 million to 161 to 210 million. But we have Disney ARPU going down in 2022. Now, why might that be? Why would their average revenue per user go down? Okay, it might go up if they're raising prices, which they did in the US last year. But it might go down if you're thinking that Disney is expanding internationally aggressively, starting in 2020 and then continuing through 2024. That includes countries like India, where they cannot charge $9 a month to the average Indian consumer. And yet they want those subscriber numbers. And so they have to charge lower rates to get subscribers on. Wall Street is ascribing value to subscribers for these streaming services. Look at Netflix 2 weeks ago. They reported numbers. They missed their subscriber number. They guided their subscriber estimate for Q1 lower than Wall Street consensus was. Netflix stock, I think, was down 30% in the next 2 days, all because they were concerned about the subscriber number. Disney cares about its subscriber number. They want subscribers in India, so they're offering Disney Plus at a lower price. So that's why our ARPU goes down in this instance. Who knows if we're right, but we have it going up again in 23 and 24. Maybe I haven't looked at those numbers closely. We'll
so for those of you on the call, just essentially think of it as ARPU is a way that the analysts can infer what is the price point essentially for each of the subscribers. What are they paying? Typically, right. This could be per year, it could be per month.
This 6816 is literally 161.6 times 42 subscribers, 161 million subscribers times $42 per subscriber. Maybe we annualize that. I guess we must to get to $6.8 billion of Disney Plus revenue.
Say, Tim, before you move on, could you just explain, like, why is your model important? Because there's a consensus model that you can pick off from the public files. The first part of your presentation just did a lot of qualitative work. And for the students that are on the call, I've heard presentations from them where they don't even refer, they don't have a model, they don't refer to a model, they don't look at the numbers, they just have a story that goes along with it. So why is this quantitative stuff important? And why is yours important?
So yes, thanks. I find that, I'm going to get to this later, the basis of my analysis and my presentation to investors is my written work. But before I can do that, I have to know the numbers. Yes, there is consensus. There is Bloomberg FactSet, whatever consensus, which is an average of every analyst's estimates, right? I have to have my own model because clients might want to know what is the Macquarie view on how this company can grow. They want to know what my thoughts are. And I put my thoughts into this. Let me give you another example. I just told you about how pricing in India has to be lower for them to attract subscribers, all right? I could get very granular on that. I could try to do it in every country. I don't, because this is too much to do. But what if an investor asked me, because this is the kind of thing they do ask, what do you think about Disney sub growth and why? Okay, I've done work in the past where I tried to scientifically estimate how I get to 161 million subscribers. Okay, I can base that on population growth, broadband penetration rates per country, how Netflix grew in different regions, and so try to come to an idea of what Disney subscriber numbers might be. Likewise for ARPU. So an investor might call me up and say, look, there's a consensus number out there for, I'm going to make this up, 155 million Disney Plus subs in 2022. Why are you at 161? I need to have an answer for that. I need to be able to explain that I'm assuming that the price cut in India is going to attract subscribers, that the penetration rates in these markets is XYZ, and so we're going to get to these kinds of numbers. So that's just an example here. And this is just one little piece, obviously Disney Plus, then I do it for these other guys. That all goes into the DTC line. It all goes into the whole Disney model. If I don't do this work, if I don't know these numbers, and I don't know all these numbers memorized, obviously, but if I don't do the work to understand what all the drivers are, what makes Disney's income statement work, if it's going to grow, where it's going to grow, how it's going to grow, how the revenue is going to grow, what the costs are. I haven't even gotten to the cost side yet. What the costs are going to be to get to that, to support that revenue growth. That is all about how Disney is going to earn money. And the earnings eventually is what drives the valuation metric. So I'm going to get to this later, but PE multiples, EBITDA multiples that I referenced earlier, I have to have my own estimates for Disney's revenues, Disney's EBITDA, Disney's operating income, so that I know what type of valuation multiple to apply to those. So I think that's the reason why we do this. And every sell-side firm has to have its own formal estimates. And buy-side analysts, our clients, also usually have their own models. Maybe they'll just like mine and they'll use mine, but they'll probably reference different people's models. And they might over time say to me, for example, I like the way you forecast Disney Plus subscribers. Can you send me your updated model, right? I've noticed how you track this. I agree with the way you do it. Therefore, can you just send me your model so I can see how you're doing? Any other questions on that? We're at 6 o'clock now. I was hoping to get through a few more slides. I was hoping to get through 1, 2, 3, 4 more slides. We'll see how far we get. I'll try to go through pretty quickly, and we can then kind of layer on, pick up on this again next week. So all of that, talking about Disney and Omnicom before that, was about revenues. Then you have to forecast your costs to understand what earnings lines might matter. So these can vary depending on the company or the industry. In software, gross profit is a very important metric. For more traditional media, operating income or adjusted EBITDA is an important metric. You have to understand what are the cost lines that go into that. I just showed you the revenue model. I have a cost model. Yeah, here's a cost model. I believe this is back on the trade desk here. Their revenue model is much, much simpler than Disney's. This is our trade desk revenue forecast. And then here are the cost forecasts, right? Platform operations, sales and marketing, tech and dev, G&A costs. All that adds up to operating income and then to adjusted EBITDA. You have to forecast each of these. The way you can do that might be, you might know, for example, that they've got a new investment cycle coming. I mentioned Charter before. New CapEx investment, they're going to amortize the cost of that CapEx. Therefore, their costs are going to be higher this year, as an example. Or sometimes you just sort of pin, a cost line as a percentage of revenues. So sales and marketing last year was 21% of revenues. We're estimating in this year it's going to be 22%. For whatever. Hopefully I've got a reason for that. So then you go on through, I'll get back to that slide again in a minute, but the different cost lines that you have to be aware of. Let me give you some interesting examples here in this little mini table right here in terms of how much things can swing. And this is COVID impacts on a couple of companies that I follow, Roku and Disney. So in 2020, Roku had a big burst of growth because all of a sudden in March 2020, everybody was stuck at home. And they ordered Roku devices and they watched Roku TV. And so Roku's business basically took off. and therefore the margins went up. They sold a lot of product, the gross margin went up. 2021, what's happening? You're cycling against that great growth from a year ago, and all of a sudden you've got supply chain constraints. Roku can't sell as many Roku devices as it did last year, or the pace at which they're selling them is reversing because ships are stuck out in the ocean, because semiconductor costs have gone up, and they're not selling as much product. So look what happened at Roku's gross margin from 2020, plus 8.5% to 2021. This is our estimate, down 10%. Similarly, Disney linear networks. Disney owns ESPN. What happened in Q2, which happens to be Disney's fiscal Q3 of 2020? Everyone's stuck at home watching TV, but there's no sports. Every sporting event in the world got canceled. One of Disney's main cost items for ESPN is the sports rights that they pay for. They spend billions of dollars every year for the right to host the NFL on ESPN, Major League Baseball, NBA basketball, et cetera, et cetera. In Disney's fiscal Q3 2020, all of those sports rights costs went away. What happened to Disney's EBITDA margin? It went up to 54.7%. A year later, all those sports rights were, all those sports leagues were playing again. Disney had to absorb all those costs again. Its EBITDA margin, mainly for ESPN, went from 54% to 31%. This is the cost of all the sports rights that Disney is absorbing. So two admittedly extreme examples, COVID related, of why you have to understand what's going on the cost lines. Okay. Some more general examples, inflation means wage pressures are going up as well. This is something companies are dealing with. Also, during COVID, companies were not traveling. Their sales teams were not out traveling to visit clients. So, their airline and their hotel costs all went down. Their wining and dining costs, taking clients out for dinner, whatever it might be, all of that went down, down, down. So they had huge travel and entertainment, T&E savings during COVID. Now you have to model in how some of those costs are coming back into 21, probably more into 2022. We basically covered that here, actually, just to demonstrate. You can see the green box at the bottom here. This is, again, the trade desk. Trade desk EBITDA margin in 2020 was 33%. We're forecasting 41% almost in 2021. Because of the factors I just mentioned, sales and marketing costs are going up as a percentage of revenue. That's the main item right there, is this number right here. It drives the EBITDA margin back down again in 2022. Right? Because they had T&E savings in 21, they're absorbing more T&E costs in 22. We're forecasting the EBITDA margin growth to be lower. Also, the revenue growth is a bit slower in 22. So we have the margin figure actually lower in 22 than 21. Okay, we don't need to worry about so much about the details, just to understand the principle behind this. More on, I believe this is still the trade desk, yes. Other factors to be very aware of. You got your revenues, you have your costs, so you have your earnings, whichever earnings line you choose to focus on. What else can affect things? Look at trade desk tax impact in 2020 and 21. For some reason, I can't remember what it is right now. They had some tax benefits in 2020. They therefore, actually, for book tax purposes, they had a tax benefit. In 21, they're paying still very low, but more normalized tax rate. This is a big change in the amount of tax that they saved versus what they're going to have to pay in this year. Similarly, their stock-based compensation basically doubled in 21 versus 20. What does that all mean? 40% revenue growth, EBITDA margins going from 33 to 40%, but their EPS only goes up 8%. That is a really low rate of EPS growth. And it's because despite strong revenue growth, despite strong margin expansion, you have this totally different tax situation and you have a very high stock-based compensation number this year versus last year. Therefore, adjusted EPS growth is very, very slow for this company. Now, we'll get on to this evaluation. EPS is not a metric that investors look at for the trade desk. They look at revenue and they look at EBITDA. So trade desk is still looking good valuation-wise on the metrics that matter. Any questions on that? I'll gloss over this pretty quickly. That's the P&L. Balance sheet, I don't obsess over too much unless a company gets over levered. I'll give you the example of Informa back in 2009. In the media sector, typically 4 times net debt to EBITDA is a pretty high ratio. Anything above that is usually getting a little bit uncomfortable in terms of amount of debt that a company carries. Net debt, of course, is total debt minus cash, and EBITDA is the last year's worth of earnings before interest, taxes, depreciation, amortization, right? So that ratio is kind of one to watch, at least in the media sector. It might be different in other sectors. Book value, you probably learned about book value in your accounting classes, your finance classes. In my sector, I don't even know what the book value of my companies is. It's absolutely not a metric that matters because these are services industries. They don't sell physical product. They don't have heavy CapEx. They don't run physical stores. It's a services industry. So book value does not happen to matter for my sector. If you were covering industrials or retail, or other sectors like that, it would matter. Cash flow, ultimately, I'm sure you get taught in school, is what really matters the most. At the end of the day, what cash does a company have? And that certainly does matter. We tend to look much more at the P&L than at the balance sheet and at cash flows. But one metric we do track for most companies is free cash flow. I'd say EBITDA and free cash flow maybe in equal measure. They matter a lot. The free cash flow calculation here being net income plus depreciation and amortization plus stock-based compensation minus CapEx spending. And this, I believe, is again the trade desk. And you notice, net income that's what it is. We talked about stock comp. They spend a lot of money on CapEx, and therefore their free cash flow is actually relatively low. Actually, there might be a mistake in here because that looks even too low for me. But 72 of free cash flow off 180 million of net income, that's a pretty low ratio, actually. The trade desk free cash flow is relatively low. I think there's only one. Now that's it. That's actually as far as I was going to get to today. So I hope that gave you some insight into the kinds of things that we look at, the kinds of factors, the kinds of things that matter. These will be different for different industries. I'm obviously presenting what matters for the industries that I follow, the companies that I follow. Hope this wasn't either too detailed or too high level for those of you that might have done this kind of thing before, trying to strike a balance in between somewhere. But hope that was useful and any questions.
So Tim, could you just say what you plan to do next session?
Sure. And by the way, I certainly hope people on this meeting now were on the meeting yesterday and will be on the ones on Tuesday and me again next Wednesday. We've tried to put some continuity to these. I certainly have continuity following on Alexia yesterday and now with my presentation for next week. So what I'd like to do next week is look at valuation. I remember it took a whole class. It wasn't yours, Lee. It was Alan Eberhard.
Yeah.
Yeah. One of the best classes I took at Georgetown was my MBA was his DCF class. And I thought, wow, DCF, wow, what a fascinating concept. I understand how to value a company now. I get to Wall Street. And do you ever look at DCFs? Yeah, we look at DCFs. I have DCFs for all my companies. Yes, they do matter. Probably spend 0.1% of my entire time looking at DCFs. Okay, now, it absolutely matters. You have to understand what a DCF is and how it works. And I do look at DCFs. But it's only the primary metric I use to value one stock, and that's Netflix. Out of 26 stocks I cover, there's only one stock I use DCF as the primary metric. I have a DCF for all other companies. I'm going to get to this next week because there can be some very interesting differences between comparative multiples, PE or enterprise value to sales or enterprise value to EBITDA, whatever the multiples may be, and what the DCF is telling you. And then I hope you find it interesting, but I cannot emphasize enough how important the presentation and the writing is. So I'm going to talk through some of the presentation and writing things that you need to know.